Guys, we are back after a 6-week hiatus. And, I think we should take more breaks because as of the last show was basically the bottom in the market. Bitcoin's up over 40% from the last show. The NASDAQ is up, I think, around 30% from the last show. So
we didn't mean to do it that way. We didn't mean to leave at the low.
Are we the new Kramer indicator? Are we the Contras?
Yeah, literally the bottom of the last show is when, or the bottom of the market and the last show is when Nikki and I took delivery and started setting up what we are sitting in right now, which is our new 30-foot Airstream that we picked up in Florida, had a badass solar system installed in it. And so for the past 6 weeks, we've been traveling through the Southeast. We're now in Texas and have just been learning the ropes. And we're planning on spending the next several months traveling through the US in the Airstream. So I'll pull up a picture, but yeah, that's basically where we disappeared to.
But it was a little chaotic because markets were moving and we were trying to get settled in the Airstream and figure out what we were doing. And then markets are moving. We were trying to make moves and buy stocks. And I think you maybe were trading a little bit in and out. And then it was just a lot to manage at that time. But we should recap some of the things that we talked about in our last show. I think that would be important. And some things that we've done in the community. I did a class in the community as we were going through this time, this chaotic time. But I remember in the last show, we were kind of debating what's going to happen from here. Trav, I know you kind of mentioned the risks at the time and things were feeling super fearful. Sentiment was super terrible. Chris, you had mentioned the pain trade being to the upside and hey, what if this is the low is in, and what if so many people are expecting so much lower in the indices and it never comes and they're just stuck and they're in all this cash and the market just V bottoms back. Well, it turns out that's exactly what we're kind of looking at here. And the debate now is this a bull market or a bear market rally, or the continuation of the bull? And I know I have an opinion on that. I don't know where you guys are standing on that, but when I did a class for the community, we showed the resemblance of now to 2018's correction, and it's literally, I don't know if you can pull up a chart, but it's literally panning out exactly.
Yeah.
The price action is crazy.
Let's do some. We'll start today with some TA and get everybody caught up on the charts and just talk about what's happened and I guess kind of what we've been doing. So for anybody that doesn't know, Trav started a new 100K portfolio. When did you start doing that?
It was officially funded on October 23rd or October 24th of 2024. So late fall of last year.
So a little over 6 months, and you've actually been outperforming the market on that specific portfolio, which is cool to see. And during the pullback and the whole tariff situation, were you kind of down in the trenches buying stuff?
Yeah, for sure. I mean, I was buying pretty consistently through the pullback, and so the portfolio today I think is up close to 18% or so, 17.5, something like that as of today. And the S&P I think is up marginally, I think up 2-ish% since that October timeframe. So pretty nice outperformance, but it's funny too because the portfolio has been outperforming the S&P with a lot less actual risk because I've had anywhere between a 30 to 45% cash position over the last couple months. So I got down I think to the low at about a 30% cash position when I was aggressively buying there in mid-April. And now today, I think it's back up closer to around 45%. So I have taken profit on some stuff that's rallied a lot. I mean, some of these stocks are up 40, 50, 60% from the lows, which is great. So yeah, I guess in hindsight, I wish I'd been a little bit more aggressive in buying, but I was able to get pretty nice size positions in the stuff that I wanted to get positions in. So some of the AI stocks like TSM and Micron, was able to build positions in Wayfair and Square at pretty low prices from a valuation perspective. Some of those are up. AMD is another one, and then some other stocks as well. So Coinbase being one, which we'll talk about later. But yeah, it's been good. But again, like you always think about like what could have been, if I had been a bit more aggressive.
If you
The winners are always the winners are always size too small and the losers are always too big. It doesn't matter how well you execute. You could always make them bigger, right? And again,
right.
for anybody watching or listening to the show, this is not financial advice. This is just what we're doing. So please consult with your financial advisor. Don't just try to blindly follow what we do, because our risk tolerance and how we're capitalized is probably different from yours. So but yeah, I mean, just really awesome volatility. I even look at like my net worth swing over the last month and I'm like, wow, like the old me would have gotten really nervous and like maybe made some mistakes. But I look at the bounce and I'm like, oh shit, we're at a new all-time high. And like, it feels good to have confidence to buy dips and to just think through the pain trade scenario, and also look at the price structure of Bitcoin specifically, and say like, hey, the longer term picture is still bullish here. And that's why, I took a little profit. Was it, I guess it was Q1. And what I did is for you guys watching the video, you can see this. I took some Bitcoin profits and I actually bought the Airstream and the truck. I already had the motorcycle, but I went on X and I said, I used Bitcoin to buy these 3 depreciating assets, which, a lot of people probably think is kind of dumb, right? To exchange the world's best performing asset for depreciating assets. And I said, why? Well, because I use Bitcoin to improve the quality of my life, not just to become the richest dead guy. So, of course we focus on long-term wealth, but don't forget to live for today. So yeah, I mean, I took profit right at 100K when Bitcoin was testing it back here in January. And here we are, right back to all-time highs. So was able to get dips and to basically rebuild back into some of that. And yeah, it just feels good to be able to sit back and have patience and look at the bigger picture and execute according to my risk tolerance, and then kind of get rewarded along the way with some toys. It's like back in 2018, Trav and I bought a really nice boat together with some Bitcoin profits. And yeah, I just like doing that every market cycle. It just kind of makes it fun, right? Otherwise, what the hell are we doing this for? Just magic points in some bank account or on a hardware wallet? Who cares, man? Let's have fun for today.
Well said. Well said.
Well, we care, but we're finding the balance. That's what we're doing.
Yeah, definitely, man. All right, so let's look at some charts. What do you guys think?
Let's do it.
All right. So
let's look at the V bottom.
Yeah, dude. Okay. So this is what I usually like to start my day with, is the big picture. So for you guys listening to the audio podcast, I'll explain what this workspace is, but I've got the 12-month chart. So basically every candle is a year. And we knew that, Bitcoin opened around this kind of 93K zone and then sold off almost to retest the prior market cycle's high, call it the 70K zone. So we came a little bit above that, but you kind of get the picture. It's about a 50% retracement of last year's candle as well. And then over the last couple of months, as we started to climb off of that low, we got back up above that 93K, and you can see it a little bit more clearly, like on the monthly chart. We talk a lot about this in the crypto market update classes that I do for the community, is showing the bigger price structure and how the bull market was still technically intact. And I believe we even talked about this in prior episodes, where when we're above that 70K zone, we're still making higher lows on the monthly chart. And so you can see the macro trend is still intact. It has not failed. And so this going into 2025 was the expectation, just based on the prior market cycles that Bitcoin's had, that almost lines up with the 4-year market cycle based on the halving cycle, right? So typically what you get is 3 green years followed by a red year, 3 green years followed by a red year. And so the expectation is that 2025 was going to be a green year just based on that. But again, there's no guarantees. There's no law of the universe that says that that has to happen. You know, the supply side of Bitcoin is pre-programmed and predefined, but the demand side is not. So as long as the demand side is there, maybe it's a self-fulfilling prophecy, or maybe it becomes a crowded trade and fails. But as of right now, it's actually working out. And when we go down to the more immediate pictures, you know, on the weekly and then the daily chart, you can see that we are also back into an immediate bullish price structure, which actually shifted in on April 22nd when we got back up above the 100 and the 200 period moving averages on the daily chart. And then boom, like a magnet, we very quickly got right back up to that 105-ish level, which is where the daily chart topped out in Q1 and wasn't able to actually close above that 105 zone. So here we are, you know, again, in just about 40 days, making just shy of a 40% or 45% leg up. So pretty significant move. And then jumping over to the NQ, the NASDAQ, which is, you know, mostly tech stocks and kind of a higher vol way to view the stock market. You can see this is also somewhat similar. Bitcoin kind of led the way and had some outperformance above stocks, but from the trough here in early April to where we are right now, that was about a 30% move on stocks, which for the stock market is a massive move in that period of time. And how funny is it just how fast market sentiment shifts? I think the last episode I actually named like something clickbaity, like how screwed are the markets? You know, because it was like just so much fear. And then when you have maximum fear and everybody's like, oh my God, Trump just ruined the global economy. A lot of times those capitulation moments or those extreme fear moments turn out to be close to the low, if not the low. So that's kind of what's happened. But on the macro side, guys, what are the fundamental or just like macro things that have impacted price and caused that price action to do what I just went through?
I think the two biggest things are, one, obviously the de-escalation in the trade war between the U.S. and China, and the U.S. and others as well. But really, the big one was the U.S. and China because it got so escalated, and we were looking at the potential for there to be empty shelves and significant inflation. And you can argue that we're still facing some of that potential with the tariffs only down to 30% from whatever they were at 100, 200%. But it is a relief that it at least means that some of the small businesses that would have gone out of business, some of the product manufacturers that would have gone out of business are going to be able to figure it out through a variety of variables that they can tweak, whether it's raising prices a little, eating some of the margin, et cetera. But so we got out of the worst case scenario with the U.S. and China. And I was surprised by that because it seemed like it was going to take a while. It seemed like the U.S. and China were nowhere close to meeting in the middle in mid-April. And then all of a sudden, you know, they went for those talks in Geneva, and they were able to work it out over a weekend to at least reduce the tariffs rates in the near term and set the stage for further talks over the summer. That can still go sideways, of course. I mean, you know, things could re-escalate. We could remain at these very high tariff levels. That does potentially mean that some businesses are not going to, you know, be able to produce products and send them over. But, you know, for the most part, we avoided the worst case scenario in the short run. That was the first big thing. The second big thing that I saw on the equity side is that we went through the corporate earnings season, and we knew going in that, you know, the numbers being reported from Q1 were not going to reflect much tariff impact yet. But we were very focused on what companies were saying about current spending patterns in April and early May. And they were actually pretty good. And they aligned too with what we're seeing in some of the hard data, like retail sales numbers, jobs data. All of it looks very resilient still. And you had a lot of the bank CEOs, a lot of the retail CEOs saying, you know, look, we've maybe seen some buying ahead of tariffs, some pre-buying stuff overall. But, you know, even excluding that, kind of odd activity, like we've seen consumer spending remain pretty healthy. There's some pockets of weakness in the low income consumer and maybe in some areas of travel, but overall aggregate spending remains up versus the prior year. We continue to hear that. We continue to hear companies, even that reported earnings last week and this week saying that things look pretty good still. So again, it doesn't mean that we can't weaken or fall off, that growth can't weaken again this summer or later this year, but it does look like things are pretty resilient. And it's funny too, because you look at consumer sentiment and it's still very much in the dumps. We're still at like multi-year lows in consumer sentiment, but consumers' behavior is very different than what they're saying in these surveys. And so, so I think it's a combination of the worst case scenario being taken off the table on the trade war, and then also the resiliency of the consumer. And those two things
Is
have
consumer
helped us go higher.
sentiment, is that just like a fluffy indicator that really doesn't hold much weight? Like how much do you guys really put into that?
Less and less, because as we see this breakdown of data, Nick, you're nodding your head because we've seen how politically biased it has become.
It's so dumb.
Yeah. You want to tackle that one, Nick? I know you posted some
Well,
things on
look,
that.
we can't take consumer sentiment seriously right now when you look at it, and it's as bad as the 2008 financial crisis, or worse than the 2020 pandemic when literally our entire economy was shut down. Like, explain that to me, somebody.
Well, yeah, and we've seen the breakdown. Like it's if you're left leaning, you're at like all-time worst sentiment ever. You think inflation's going to be 8%. I mean, none of that really matches up with the actual data where we see inflation continuing to cool. April and May numbers look very cool so far. And then of course, if you're on the Republican side, it's the opposite. You expect the economy to improve, and this is on average, right? These are averages, but it's crazy to see how divergent the consumer sentiment is between political party affiliation. And I think a big part of that obviously is because the Trump administration is so polarizing, and we just came off the election late last year, and so there's very much a political bias now in the consumer sentiment, more so than we've ever seen. That's a big driver as well.
I'm not denying that there are people going through it right now and having a hard time. We know that especially certain types of consumers are struggling as the credit card debt piles up, the student loan repayments start up again. We know that, but of course, when we're looking at it in aggregate, it's kind of hard for me to come to the conclusion that we're worse off than we were in 2020 and 2008. For those of us that were around in 2008, we remember that feeling, and it was really bad. So that's why I think I'm struggling with it, and retail sales aren't helping the case. Just certain things that I'm seeing out there. The labor market is not as bad as it has been in previous times. So I think that's why I'm having trouble with the disconnect here. Consumers and they're saying one thing and then they're doing another.
And I think you mentioned the jobs data holding up, and that's a big part of the story, because it may very well be the case that the manufacturing sector in aggregate may be in a mild recession. And you look at a lot of the manufacturing surveys, and the data is abysmally bad, but 90% of the U.S. economy is services, not manufacturing. And so when we look at the overall jobs numbers, they continue to be pretty solid, like 4.3% unemployment. It still remains very, very low. So that is enabling consumers to continue spending. The other factor that's probably worth mentioning here as well is fiscal spending. We're still spending like I think in excess of 5 or 6% of GDP in terms of the budget deficit this year. And it looks like, there's this big, beautiful spending bill that the Trump administration is trying to get through Congress. And that looks like it's going to have some tax cuts embedded in it. It's going to have, basically it's going to be the same old story. It's going to be more deficits as far as the eye can see. Like the Republicans had a message that they were going to use Doge and other tools to cut this budget deficit down. And they have cut a small amount, much less than they said they would in terms of Doge, like 150 billion versus their 1 trillion target. And then on top of that, you've got any savings that you got from Doge or any other efforts being completely offset by things like tax cuts and other measures in the spending bill. So it looks like as far as what we can see today, we're going to remain in a heavy fiscal deficit spending, which does support the private sector and does support the economy overall. So that's one part of the potential bear case also maybe taken off the table.
So one thing, yeah, to your point, I know on Thursday we're going to get the initial jobless claims, which, have still not shown any, I think, big impact from the tariff situation yet. Do you guys think that's going to heat up, or do you see that as kind of just going to kind of work itself out, or are there any, black swans to watch out for in the employment stuff?
There was talk of, there being this potential contagion effect where, you've got small business importers and manufacturers that could go out of business, and then you could have jobs being lost in the trucking sector and the transportation sector, and then eventually the loss of those jobs could bleed over into the services sector, where you see less spending and therefore you have layoffs. But we're not really seeing that at this point. So again, it could still happen later in the year, but we're not seeing it yet. The other thing too is, with the worst case tariff situation taken off the table, you do have probably less of an impact on the transportation and trucking sectors than you otherwise would have if the U.S.-China situation had remained, at an unworkable tariff level for months and months on end.
Yeah, something else I saw was Microsoft, I think, just laid off 7,000 people because AI is taking those jobs. So I wonder if we're going to see an acceleration of that this year too.
That's very interesting. On the one hand, you've got significant investment spending and CapEx happening in AI. The numbers continue to rise dramatically this year on data center spend and overall investment. You had big investment announcements out of the Middle Eastern Saudi meetings just a couple of weeks ago. You've got still all the big tech companies saying that they're short of GPUs and they're continuing to spend aggressively. So on the one hand, you have this massive investment boom with AI, but on the other hand, like you mentioned, there's potential for it to actually take jobs away. And so that's, even Meta, Mark Zuckerberg is out there on earnings calls saying that they hope to have like a mid-level software engineer, capability in their AI agents later this year. So they potentially could be doing a significant amount of their software work using AI software agents. Now, he's also said that he doesn't expect to lay a ton of people off because of that, but rather than having significant aggressive hiring plans, those jobs will instead be taken by AI agents. So it could be one of those situations where maybe it doesn't necessarily lead to like direct high employment in the short run, but it means that we may remain in a very weak hiring environment. It gets very difficult to find a new job if you lose your existing job. That could be one case as well.
Another piece of the economy that is kind of freaking me out is the real estate market. So this week we've also got existing home sales coming, and those have been showing not promising signs for the spring, kind of going into the summer. And I think it has something to do with this chart. So we're looking at I've got the 10 and the 30-year bond yields, which is kind of looking like a bullish chart, like an ascending wedge, potentially about to break out above 5% on the 30-year, which would be really bad for mortgage rates. Right now, rates are still hanging out kind of sub 7. But yeah, what do you guys see there? I know this is something that, a lot of people have been focused on over the last year, as it looked like rates were coming down, and then, oops, they're actually holding like higher lows, even on like the 10-year.
So part of me thinks that, like when I look at that, I go, oh, okay, the market's worried about, these ongoing fiscal deficits with the U.S. government, the new spending bill, not cutting spending, but potentially even increasing deficits for the next few years is a real concern for the bond market. But then I look at other markets. I look at other countries like Japan, the UK, pretty much any country in the Euro. This is like a global phenomenon. We're seeing bond yields rising globally. And so, it could just be that the rise in the U.S. yields are pressuring other yields, but it's a very interesting dynamic. It almost feels like there's something else at work here, with essentially long-term bond yields going up in almost every major country that we look at. It almost feels like it's something else that's driving it, rather than fears about the U.S. government finances. Maybe it's fears about government finances just globally, Or maybe it's that, investors expect a high growth, high inflation environment over the next few years globally. Yeah, a global boom, you could say. So I haven't quite figured out, what's really driving this at this point. But there's definitely, there's definitely some things to be nervous about with the action in bond markets right now, with bond prices, long-term bond prices going down and long-term yields rising. It's certainly something that could create, put a halt to the current equity market rally. So, at least in the short run, in the long run, if what's driving this is government fiscal deficits, then you want to own assets like crypto, like Bitcoin, at least, and stocks, that are going to typically gain in value over inflation. So, that's the interesting paradox here, is like, you want to be in assets that have a history of beating inflation. So you don't want to get too bared up. On the other hand, sometimes when we do get these fast rises in bond yields, you do have a pullback in risk assets. So it's something to think about.
Yeah. I'm pulling up the top assets by market cap, and a thesis I made, I don't know, 6 months ago when Bitcoin was kind of challenging silver, is I thought that in a higher interest rate or kind of a lower trust environment with the government debt situation, I think Bitcoin was going to make a kind of a speed run through these stocks, and it's already overtaken Google, aka Alphabet, and it's now the sixth most valuable asset in the world, sitting at 2.1 trillion. And we are right behind Amazon. So we're knocking on Amazon's door at 2.15 trillion. So I think a breakout to all-time highs would easily overtake Amazon. And then quite a bit above that is you've got Apple, Nvidia, and then Microsoft all kind of sitting right around that 3 trillion mark. So my expectation is that Bitcoin is doing this. It's, I call it a speed run. I mean, it could take years, but it's like I think that the bull case is on, and it's working its way up to gold. How long will that take? Is it going to happen overnight or decades? We'll just have to see. But yeah, I think the whole interest rate and government debt situation and narratives are driving more and more people to Bitcoin. And I saw, like, in the US, I saw a chart today that showed that about 20 million people in the US own gold, where already about 50 million own Bitcoin. So that's kind of an interesting angle as well.
Something I also think, go ahead, Trav. Go ahead.
I was just going to remark that just a casual 10x will get it up to the level of gold.
Yeah. A million, reasonable. And into 2025, right?
That's right.
Interesting right now, because it feels like, Trav, to your point of like trying to figure out what's going on in the bond market and what it all means, it kind of feels like Bitcoin is in this situation where it's going to be okay either way. Like if risk on is back, right, Bitcoin is okay. If there's fear over the dollar or debt, deficits and things like that, it seems like Bitcoin's going to be okay there too, because people were already starting to flock to it, similarly to what they were doing with gold. Now, of course, risk on is back. So it's interesting to me how Bitcoin was starting to have that decoupling from the broad US market. And now it's probably going to be fine either way, whether things are about to deteriorate or risk on is back and where the bond market is doing what it's doing because of growth expectations and inflation expectations. So I find it to be in a unique spot right now that I don't think we've seen it in before, at least that I can recall. So I think that's cool. And then one thing, going back to the housing market, I've been kind of surprised that housing prices haven't dumped more. I know certain markets have seen some pretty significant declines in housing prices, Austin being one of them. But when I was looking at the median sales price for new and existing homes, I was kind of surprised we haven't seen more downside, especially existing. Like new homes, they've come down, but existing homes have stayed stubbornly high. And so I'm thinking about that aspect too, how a lot of people still have a lot of equity in their homes. how that's going to affect any potential recessionary fears going forward. But I think until I'm just surprised housing prices haven't cracked more, at least generally speaking, nationwide. I think that's a big problem right now, with rates staying stubbornly high and prices staying stubbornly high as well. Because even buying a house in Austin, it's still expensive. It's still crazy, you can't afford it. Still doesn't make sense to buy here over renting, and the same in many other areas. So I see both sides of that. I see how it's an issue, but I also see how home equity is probably going to stay intact for a lot of people, which could be a good thing that we didn't have in 2008 if things start to deteriorate more.
Yeah. So, Nick, to your point, I'm pulling up the U.S. single family home prices index in TradingView. And you can see, like, right before the '08 financial crisis, there, like during the summer peaks, that, prices kind of like peaked out and started to make like lower highs here. And that's what happened. We made a lower high in 2023, but then 2024 made a higher high in prices. And so, yeah, to your point, it's like
Exactly.
prices just aren't coming down. Yeah, maybe if this summer season is weak, maybe that's the start of a crash. But yeah, you would have thought that by now prices would have come down much more, right?
Yeah. So affordability is still a huge issue, but the flip side of that is people still have a lot of home equity to survive any kind of potential recession from tariffs or whatever it is that's going to bring us down. So such a unique environment right now. And even I was even talking about this in the update Monday, how with bond yields up and Bitcoin doing what it's doing, kind of either way being a good asset to own, and equities kind of back risk on, it feels like a good time to be a diversified investor right now. Assuming you're not trying to buy a house, and assuming you've bought bonds more recently, the yields are pretty good. You collect your coupons. You've got Bitcoin, which is doing really well, kind of either way. You've got gold, which seems to be doing well as well, and equities. I mean, it feels like a really good time right now for a diversified investor.
Yeah, I mean, and those are usually the best times to be buying dips, is when everybody's fearful. How many times have we seen it over the past just decade? 2018, 2020, 2022, more recently this year. It's like all these gifts of pullbacks, that every time it seems like the world is ending, and every time, investors and dip buyers get rewarded.
Yep.
Nick, there was a tweet that I wanted to pull up, and we can keep this a shorter class. I know you guys are busy this week, but I thought this was interesting. Nick sent a post out saying it's far underestimated how valuable even small portfolio tweaks can be to your net worth. Do you want to talk about like some of the problems that you listed here and like kind of expand on this? I think this is just like really good education for investors at all levels.
Guys, I've reviewed a lot of portfolios, and from DIY investors, know more about the markets than the average person. From those that aren't managing their portfolio and someone else was managing it, when I looked at it, and man, the mistakes are far and wide. You'd be so surprised. A lot of this, holding too much cash or too many lower risk assets, a lot of people take on too little risk, honestly, for their situation and for their goals. I've seen some very over diversified portfolios, and you might be thinking, how is that possible? How can you be over diversified? You can be. And
What would that look like? Give an example of like what that would mean and how you would notice that.
So basically, I've seen portfolios with hundreds of holdings in them, or dozens of 100 holdings or 75
Wow.
holdings. a lot of them being individual stocks that just weren't high quality, or some of them were fine. Some of them I'm like, what? And the position sizing on them is terrible. It's a lot of positions, smaller sized, right? So you're not going to have that much of an impact. You want to
At
have
that point, it's like just own the ETF, right? Just own the S&P
Right.
500.
yeah. And so it's just things like that that I've seen. And then obviously under diversified people that are like 100% in VU, or the S&P 500 or something like that.
Mm.
Not reinvesting dividends is a big one. And I like to remind everybody, this past correction we've had where we were down 20%, it's nice, especially when your portfolio gets larger, to make sure your dividends are reinvesting, because guess what? You're buying dips with those dividends. So that's something that I see often, because advisors try to keep cash in the portfolio so they can, get their fees out. So a lot of times they just don't even reinvest the dividends. And that, I think, is an issue. Lower quality stocks. We see this all the time. People think that they've found the next big thing, and you go in and you look at the stock and it's like, this is trash. This is, they're issuing tons of shares. They're not profitable, whatever. And they have a lot of them, or they're very concentrated in them. So that's a big one. Obviously allocation issues, just your weightings are off. Your allocation to the different types of assets is off for the goal. And then a big one is unnecessarily expensive funds. I hate this one. It drives me crazy, because the mutual fund world has really screwed a lot of people with these high fee funds that now you can get the same exposure for much less cost in an ETF format. So a lot of people just don't know to look at that. They don't know to think about it or how to research it. And so they get kind of stuck in these things. So those are just like the main issues that I see.
Yeah, I think that's really helpful. I'm sure people are listening going, oh, wow, I'm probably doing at least one or two of those things.
Yeah, but the main point is like it only takes a few good tweaks that can really extend, what kind of net worth you can grow over time. It's just huge.
Yeah. I mean, to kind of compare that also, or apply that to crypto, it's like sometimes I'll be talking to people that tell me like, yeah, they're quote unquote diversified in crypto, and they've got, 50 or 100 tickers. And it's like, why? 99% of those are going to zero. But I think people make the mistake thinking that cryptos are like stocks, and that they're actually profitable companies, which most of them are not. They're just speculative, like trading vehicles that are eventually going to blow up. And we've seen that even to this day. Looking at the Bitcoin dominance chart. I've said this since the bull market started in early 2023, that we're in a Bitcoin bull market, and Bitcoin has just eaten the lunch of most alts. And yeah, we had a little bit of a pullback in dominance, and so alts got a little bit of alpha in May, but boom, it's right back up. And so yeah, I mean, just kind of, I guess, transitioning to the crypto market, that there was a big pop in ETH, and a lot of people got excited here. But one thing to keep in mind is we're still below the 200-day moving average on the daily chart in ETH and a lot of altcoins. Like if you look at the others index, we're still below the 200. So the risk appetite for just quote unquote crypto is pretty bearish still, where for Bitcoin it's absolutely like a rush to accumulate. I mean, we're seeing just more and more large governments, treasuries, funds, all the big boys are accumulating, and we're seeing exchange balances decreasing, meaning the amount of Bitcoins on exchanges continue to go down. So lower supply, higher demand. What happens to price? I think that's why we've seen this aggressive bounce in less than 6 weeks, over 40% upside, right? So that's just kind of my read on crypto in general. But Trav, I wanted to flip it to you, because there's been a lot actually happening in like individual stocks. I mean, from like, Coinbase, UNH, like I think, some stuff's going on in SPACs. Like, what are the general themes that you're seeing out there? What's interesting? Where maybe is there alpha? What are you looking at? What are you hunting for? Yeah, just give us your read on it.
Risk is back. I mean, that's been the theme the last few weeks, and it feels like people are going further and further out on the risk curve. So I'd even maybe wager to say that SPACs are back, at least in a small way. We've seen some SPACs that have gone parabolic, and a lot of those actually have been crypto related. So there've been a few SPACs that are acquiring crypto related companies or are initiating like a Bitcoin treasury strategy. So a big one was CEP, and that company is basically going to be kind of doing what MicroStrategy is doing and trying to acquire more and more Bitcoin over time. And so interestingly enough, those have had a great reception from the market. And that's causing people to get excited and look at SPACs again as a potential way to, play new exciting companies coming to the public markets, or even just for short-term trades on some of these things. So that's been a theme that's starting to heat up that we're seeing. We've also seen, a number of companies making huge moves. Coinbase up like 23% on the day they got added to the S&P 500 last week. We've had pretty big moves in stocks like Tesla. We're seeing big moves in like some of the other EV stocks like Lucid even today. A lot of
Trev,
the AI
talk a
names.
little more about like Tesla, dude, because this one was absolutely clobbered, and everybody was lighting dealerships on fire, and it was down by over 50%. And since then, there's been a pretty significant bounce since the market bottomed. It's up over basically 65% from that pivot low. Is there any insight, any changes fundamentally, or is this just a volatile kind of emotional stock?
It's in some ways it's very confusing because the last quarter that Tesla reported was abysmal, and even trending into this quarter, the numbers that we have so far on Tesla's auto deliveries, even quarter to date, looks very, very weak, down year over year by double digits in most countries. So the fact that stocks rallied so much has a lot more to do with like sentiment about their future bets around things like the autonomous vehicles. So they're going to be launching testing of AVs in the Austin market here this summer. So there's been some rumors, or not rumors, but there's been some details leaking out about how they're coming to market with that here in Austin in the next few weeks, and that's gotten investors excited. The fact that Elon is stepping away from some of his government work like Doge, to come back to Tesla and focus more on Tesla and some of his other companies, I think got people excited. And then, probably a lot of people that were short the stock and or avoiding it, or that sold it, and now they're buying back at higher prices. That probably has something to do with it. We're also seeing a ton of options activity. So the options market is causing some of these big moves as well. We've seen, options activity be super, super heavy in stocks like Tesla and Nvidia that have rallied recently. We're starting to see it again, like I mentioned earlier, where risk is kind of creeping out to even more, I would call it trashy stuff. We're seeing like a return of like very interesting, way out of the money call option action on stocks like GME. The highest, so GME today trades for $29 a share. And if you go to the June monthly options expirations and you look at the options open interest, the strike that has the highest open interest by far is the 125 strike call option. And so, people are making heavy bets on some of these stocks to make significant moves. So very interesting to see that. That's certainly causing some gamma squeeze pressure on some of these stocks. So I would say Tesla's benefiting from a confluence of sentiment, technical factors, even though their core auto business is not doing well. So that's been a very interesting one to watch for sure.
Robotics, baby. That's the new narrative.
Yeah, robotics is getting a lot of attention right now. I actually just invested in a humanoid robotics company last week that is doing a Series C round. So I'm also myself involved in the hype cycle for robotics. But yeah, things are heating up.
Love it, man. All right. Well, what are the big things that people should be watching out for over the next couple of weeks?
Well, we've got a Fed meeting coming up in June. We've got, we've got some stuff like NVIDIA earnings and GameStop earnings on deck as well. Although Other than that, I would say it's a little bit more of a quiet time period. You start to go into like late May, early June, and there does tend to be less things like earnings or specific company events. You also have people starting to go on vacation, things like that. So that's why there's that old saying like sell in May and go away, because the summer can often be a chop fest in stock markets. I don't know about this year. It's hard, maybe too early to say what it's going to be like, but we do have a few things, like I said, like Nvidia, GameStop, and then the Fed in June. I do think what we're seeing in bond markets is also worth watching. Obviously, that is a developing dynamic. And it's also interesting because we've seen a lot cooler inflation numbers, not just in the US, but in a lot of countries lately. And that is in stark contrast to what we're seeing in bond yields. So something's got to give here with what we're seeing in those dynamics.
Gotcha. Yeah. Talking about just what I'm looking at in the crypto market, we've got potentially some high volatility coming in. Nick, I'm going to mute you. I think your mic switched over. High volatility on the Bitcoin chart up here around 105. Anytime Bitcoin tests a new all-time high, usually you get, big stop runs on both sides of the market. So we've been in this like really pretty upward trending channel run retracement extension really since the pivot low in April. And now here we are sitting right at that key 105. So I wonder, did we actually make a new daily close high yesterday? The close was 105,600. No, it was real close though. That was really close to being the highest daily close ever. So I don't know. I mean, I think, usually what happens is when you attempt this, you get a lot of stops that start stacking up below the last pivot low, and then you'll see like runs through those. So we're still like significantly above the 100 and the 200 period moving average, and even just the 50 period moving average. So yeah, I mean, I see two scenarios. One is either a pullback to those moving averages to like take out any over leveraged kind of weak hands, or the pain trade just like accelerates and we get a pop stop run above like 110. And then the next kind of magnet area that I've been talking about for I think a couple of years now is 120. So if we do that scenario, I think 120s is maybe the next like big magnet area just based on fib extensions and measured moves. But that's kind of my play, man. I mean, I haven't been making a ton of changes recently other than just looking to take advantage of dips, hold on for the ride, not get over levered on anything, and certainly not chase any shit coins that are bleeding out. So all right, Nick, anything final that you want to mention for people?
Well, something I'll be looking at is we've have some more retail earnings coming up this week. So some of the big box names like Ulta and Target, I'm going to be listening to what they're saying, what insights they have, especially going into May, the beginning of May. So still a lot on my end and on the earnings front as a retail investor. So looking forward to seeing what we hear to give us insight.
I'm muted. There we go. Okay. Well, it's good to be back, guys. Thanks for listening. Make sure to go to wetalkmoney.com, leave a question for the show. I think next show we'll do like a big Q&A show since we haven't done one of those in a while. And feel free to hit us up on social. Again, these are the times to be disciplined. Hopefully you took advantage of some dips. If not, guess what? There's always another trade or opportunity right around the corner. And yeah, Trav, Nikki, as always, thanks for your wisdom, and we'll see you guys next time.
Cheers.
Take care.